Running into the second part of valuation inventories on the cost basis approach, we're looking at determining the costs of goods sold and what is actually included in our inventory costs. So when a company actually receives title and control of the asset, that is the point at which they recognize the inventory in the accounts payables. Passage of title is often used to determine control because the rights and the obligations are then legally established. This occurs during FOB shipping point or FOB destination. For FOB shipping point, the buyer is actually paying the freight costs and ownership of the goods are going to pass to that buyer at the point in which the public carrier accepts the goods from the seller. The seller washes their hands when they hand it over to the person who is going to move them. For FOB destination, the seller is paying those freight costs and they remain obligated and legal owner until the point in which the buyer receives the actual product and they take physical and legal control at that exact point in time. One of the things that I want you to always keep in mind is that consigned goods are another factor. A lot of companies work on consignment. Goods that are on consignment actually remain the property of the consignor. This is the person who owns them and hands them over to another company in order to sell them. The consignee, the company who is actually going to sell those goods for the consignor, actually has no inventory or legal obligation title held to that particular good. It is not their inventory. They are only a holding spot for it. There are some special sales arrangements that might come into place, such as sales that have a repurchase agreement. These can also be called product financing agreements, and they usually involve a transfer or a sale with either an implicit, which means that it's understood, or an explicit, in which there is actually a written and agreed upon repurchase agreement. These arrangements can be called parking transactions. We recognize revenue at the time the inventory is parked. Um, if we were to do that, recognizing it at that point, it would violate the revenue recognition principle. That's because the performance obligation is not met because the control has not been transferred to the buyer because the seller may have the repurchase situation in place. Sales for goods that have high rates of return. We record sales revenue at the amount that we expect to receive from the transaction. So we're going to establish an estimated inventory return account at the date of sale to recognize that some of the inventory will be returned. Product costs. Costs directly connected with bringing the goods to the buyer's place of business and converting those goods to a saleable condition. These are the different types of costs that are going to come into your costs of goods sold. This is versus period costs. For the most part, you're going to see these as the general selling and administrative expenses. These are things that are going to occur every period. They're not tied directly to converting the good to saleable condition. They may be the act of actually selling it. They may be the rent. They may be something along the lines of the HR personnel, things of this nature. And then there's the treatment of our purchase discounts and whether or not we use the gross versus the net method. So let's look at purchase discounts. We purchase with costs of $10,000, terms 210, net 30. Keep in mind when we're looking at purchase discounts, we are the buyer. We are the merchandiser bringing in merchandise in order to sell it. Please recall that when we have terms such as 210 net 30, it stands for 2% discount if paid within 10 days. If not, the entire bill is due in 30. So for that entry, we have purchases of 10,000. We're going to be using the periodic system here. And accounts payable at 10,000. This is when we're using the gross method. Now, invoices of 4,000 were paid within the discount period. We reduce our accounts payable by 4,000. Now 4,000 times 2%, because we're within the discount period, we're within those 10 days, is $80. So we have purchases discounts, which is an account that is a contra account to purchases that we recognize for $80. And then cash of $3,920 that we actually paid out when we paid this particular portion off. And then the rest, the 6,000 remaining, we pay after the discount period. So our accounts payable will reduce by 6,000, showing that we're no longer obligated to pay anything else. And we have to pay cash of 6,000 because it is after the discount period, therefore it is net. So total, in all, we recognize 10,000 times 98% would have been 9,800 if we'd have paid within the discount period. However, we only paid part of it within the discount period, meaning that we paid $9,920. So we did lose a pretty significant amount of money by not paying within the discount period. Now, if we're functioning underneath the net method, then when we make the purchase, we recognize it instantly as if we were going to take the full discount amount. So purchases are 9,800. And accounts payable is 9,800. When we pay the first payment, we reduce our accounts payable by $3,920. That is the 4,000 multiplied by 0.98, giving us $3,920. And then cash of $3,920. However, because we did not pay the full thing within the discount period, when we come to paying the $6,000, first we recognize a reduction to our accounts payable for the remaining $5,880 of net. So this means that we initially recognized it as if we were going to take the full discount. We have a discount called purchase discounts lost that we will post $120 to because we owe a full $6,000 to our vendor, and then cash of $6,000. Either one of these is acceptable to use in practice. Now we are going to describe and compare the cost flow assumptions that are used to account for inventories. These should not be new to you. You should have been exposed to these in prior classes. There is a variety of them that you can use. You can use the specific identification, FIFO, LIFO, or average cost. The most important thing to keep in mind is that your cost flow assumption that you adopt does not have to actually be consistent with how the movement of the goods physically occurs. Methods that are adopted should be one that most currently reflect periodic income. However, due to changing economic conditions, sometimes your cost flow assumption is not going to reflect your most periodic income. This is a problem with having an assumption. However, specific identification is not something that is practical to use in all situations. So let's look at Callmart. And they have these transactions in their first month of operations. And we're going to calculate the goods available for sale. We started with $2,000 at $4 a piece, or $8,000 worth of inventory. We're using the periodic method here, so we're looking at purchases, and we're going to back into the numbers. So with purchases, we had 6,000 units, $4.40 a piece, giving us $26,400 worth of purchases. We had another 2,000 purchases at $475 for an additional $9,500, yielding us a total goods available for sale of $43,900. We're trying to determine what the costs of goods was for the 4,000 units sold or issued on March 19th. So under specific identification, we include in the cost of goods sold the cost of the actual specific items that are sold. Typically, specific identification is going to be used when we have a small number of very high ticket items that are easy to distinguish. Items such as vehicles, boats, furs. Some cases, companies use them for large appliances. This matches the actual cost of the good that left against the actual revenue that was generated by selling that good. The cost flow is a direct match to the physical flow of the goods. However, it could allow the company to manipulate their net income. And this could happen if they decide to choose a different item. So they have 6 items relatively identical, and they choose to sell the one that has a higher cost associated with it rather than one with a lower cost. This is going to give them a lower net income, and vice versa. Now, Walmart 6,000 units of inventory consisted of 1,200 units from March 2nd, 3,000 from March 15th, and 2,000 from the March 30th purchase. So we need to determine the amount of ending inventory so that we can determine the amount of cost of goods sold. So 1,000 of the units are from the $4. 3,000 of them are from the $4.40. 2,000 of them from the $4.75, giving us a total inventory unit count of 6,000 for 26,700. So the cost of goods available for sale we knew was 43,900. We've already computed that. We need to deduct the ending inventory of $26,700, and that tells us our cost of goods sold is $17,200. Now keep in mind the IFRS actually preferred the inventory method of specific identification unless it's impractical to use. Unfortunately, in a lot of cases, specific identification is impractical to use. Average cost. This is the cost flow method, which is the middle road between FIFO and LIFO. It takes the changing cost values, the different prices that you're experiencing as a merchandiser, and it kind of levels them out. So your prices for items in the inventory is on the basis of the average costs of all similar goods that were available during that period. It's not very subject to income manipulation because it is an average. So you can't say, I want to choose this one or I want to choose that one, or time prices are rising or prices are falling. So these are better methods. And it's the measuring of a specific physical flow of inventory on this is not possible. You really can't say whether or not first in is the first one that left, last in is the first one. We're just taking everything, putting it in a bucket, mixing it up, and we're saying, okay, this is what they are. And we're going to go off of that. So using the weighted average method, same situation. The exact same purchases. We have a weighted average cost for the 10,000 units with a total cost of $43,900 of $4.39 a piece. We have ending inventory of 6,000 units. So 6,000 units times $4.39 is $26,340. Our cost of goods available for sale, that was the first thing we calculated, 43,900 less 26,340 gives us a cost of goods sold of $17,560. Now there's the moving average method. This is what we use with perpetual inventory. In this method, we will compute a new average unit cost every time we make a purchase. So we have 2,000 units of $4. Then we had an additional 6,000 at $4.40 come in, which gave us 8,000 units at $4.30 for the total 34,400. So when we engaged in the sale on March 19th, the actual cost associated with that was $17,200. It is 4,000 units at $4.30 a piece. We brought in an additional 2,000 units at $4.75 a piece, changing our new moving average weighted cost to $4.45 a piece. This is 4,000 units at $4.30, 2,000 units at $4.75, giving us a total of 6,000 units for $26,700. First in, first out. This is the cost flow assumption that ideally is going to mirror the physical flow of the goods. Most organizations want to move their older items that have come in first. It's going to assume that goods are used in the order in which they are actually purchased, and the inventory is close to the current costs. So it should closely reflect, maybe not 100% accurately, but it should be close to the replacement cost. However, it does fail to match current costs against current revenue when prices are changing. Using the periodic inventory method, we're going to determine the cost of the ending inventory by taking the costs of the most recent items purchased and then working backwards until we account for all the items that are left in inventory. So we know there were 6,000 items that were left in inventory. We have the March 30th purchase of 2,000 of them at $4.75. So there's 9,500 that's still in inventory. And then 4,000 of them were purchased at $4.40 a piece, giving us $17,600 of them that are still left in inventory for a total ending inventory of 6,000 units for $27,100. We know that our cost of goods that was available for sale that we calculated at first was $43,900. When we deduct the ending inventory of $27,100, that gives us a cost of goods sold of $16,800. So we assume that the most recent purchases are still there, that is what our ending inventory is comprised of. Underneath the perpetual system, because remember this is the continuous logging, it gets a little bit more complicated. So we have our 2,000 units that were purchased, our 6,000 units that were purchased, and you see how we make up the ending inventory at each time. We add the specific units, and then we have a balance. We sold 2,000 units. We are first in, first out. So the first thing we do is we look here and we see 2,000 units of $4. So there's 2,000 units at $4. We sold a total of 4,000 units, so we need to pull 2,000 of the units from here at $4.40, giving us a total sold of $16,800. Our new makeup of our inventory at that point, we had a total of 8,000 units, and we sold 4,000 of them. And the 4,000 remaining units are at $4.40 a piece. Is ending inventory is $17,600. When we purchase that final purchase of the month, We now have 4,000 units at $4.40, 2,000 units at $4.75, for a total of $27,100 of ending inventory. The next method that we'll talk about is the last in, first out method. So this is an assumption that we are going to move through the last in as the first out. IFRS, it actually does not permit LIFO, although it does provide, theoretically, the closest pairing of revenues and costs. So again, we have 6,000 units that are left. We're looking at last in being first out. This means that the older units, the 2,000 that we had on hand at $4 a piece and 4,000 at $4.40, provided us with ending inventory of 25,600. Our goods available for sale was 43,900. We reduced ending inventory by 25,600, giving us an ending inventory of 18,300. The cost of the total quantity sold or issued during the month comes from the most recent purchases. Again, as I said, this is going to pair the expense and the revenue most closely to the ones experienced. In the perpetual inventory system, we're going to have a different ending inventory and cost of goods sold amount than we calculate underneath the periodic method. And that is because we have our 2,000, we have our additional 6,000 purchased at $4.40, and then we have 4,000 that were issued at $4.40. And that leaves us with a remaining 2,000 at $4 and 2,000 at $4.40. Therefore, at the very end, we're going to have 2,000 from the first issue, 2,000 left from the second, and then 2,000 from our most recent purchase, giving us 26,300 of ending inventory.